Ladies and gents, traders and investors, a very warm welcome to our channel Polo Vega. On today's video presentation, we shall be talking about different option strategies that we can use for getting into breakout trades. When we talk about breakout trades, we expect the price of the underlying asset to go through a very wild swing or to print a very bullish or bearish candle in the near term or the short term. In case we go into the breakout trade, we are basically looking at a very instantaneous decision or a very short-term decision which is being taken with the expectation of some news or some information getting released in the trading environment which could trigger the sudden or volatile move of the price in either of the two directions. The trader here is preempting a violent move and has to take adequate precaution to guard himself against losses if the trade doesn't go or doesn't move at all in his expected direction. The benefit of using some of the strategies that we're going to talk about today is that even if the trader is wrong in his direction, but if the market moves in a very volatile way or in an explosive way in a counter direction as well, even then the trader ends up making a profit. Time decay is a very essential part of this trade, and the trader has to be absolutely cautious about getting his timing correct. A delay or an extended stay in the trade is going to make him lose money, and one has to be very well informed about the open interest conditions, the timing conditions, the release of the information on which the trade depends as well has to be timed very well. And we shall talk in detail on different strategies that we could get into once we've finished talking about the different trades which were the highlights of this week. The first of them all is the US oil spot, which has had a wild ride during this week. It has recovered almost all its losses since the peace deal was announced and is trading around the 92 to 95 area as we speak. It had 4 bullish days, Monday, Tuesday, Wednesday and Thursday, followed by a moderately bullish day on Friday as well. The other charts that we shall be visiting shall be the US dollar index or the Dixie, NQ, the Nasdaq based India index, ES, the S&P 500 based India index, XAU/USD, the gold based ETF, XAG/USD, the silver based ETF, and last of all, we shall be visiting the Nifty or the National Stock Exchange Index, which is trying to come back down below its support area as we speak. Disclaimer/disclosure. The contents of the presentation are for information purposes only. The material has been obtained or derived from sources believed to be accurate, but we do not guarantee its accuracy. The presentation is the second of a series of interactive videos aimed at educating our viewers, and we'd like to warn all our viewers of the risk associated with the business of trading and investment. Securities investment and trading is a highly risky business, and there exists a possibility of partial or total loss of investment. The ideas and opinions in our video are solely based on our analysis of the market, and we do not advise, recommend, guide anyone to take any trade based on the contents of the video. We do not take any responsibility for partial/total losses arising out of trades based on the contents of this video. Traders and investors, the chart on our screen is that of US oil spot, and we're looking at the daily chart. US oil spot has had a very explosive week, and it has printed a series of bullish candles, and we expect the asset class to stay bullish until there is some news from the countries at war that they're going into a ceasefire or there's going to be a peace deal between the two. But otherwise, we can continue to expect the price of oil to go up every singular day, and there are no shorts that one can get into as we speak. The best place to get into is a long on the daily chart is at 81.0, which is still quite far from the area that has closed on Friday, that's at 89.3, but we can try to monitor the movement of the current price on the lower time frames, where there could be a chance to join the newly established uptrend since the commencement of the war a second time. But one has to be a little careful because there is going to be a lot of volatility in the market, and that is going to be injected by news coming out of the war zone. So any news that can allow people to think that the war is going to come to an end, and the Strait of Hormuz, with the strait controlled by the Houthis as well, is going to be open for trading of vessels, then the price could come back down, but still all the drops could be taken advantage of, and look for strong demand zones to get into long trades, at least for the next couple of days. The chart on our screen is that of Dixie, the US dollar index, and we're looking at the daily chart. Dixie has had a very good run last week, printing some nice bullish candles, and it has managed to close at 101.302 and is trying to take out the sell orders from the supply zone between 101.077 and 101.887. That's a very strong sellers area, a long established supply zone with a lot of sell orders left behind sometime in April 2025, and this is the second time that Dixie is trying to take out this particular supply zone. Earlier on, it tried about 2 or 3 weeks ago in the middle of or towards the third week of June, when it touched 101.6, which was at the time of the Fed announcement, and now it has come back to this area once again, and one needs to see if its continued strength under the influence of rising oil prices allows it to take out the supply at 102 and close above the area to announce the beginning of an uptrend in the US dollar index. We all know very well that the Fed is not willing to go for a rate hike or for a rate cut, and is willing to maintain a steady state until the need to intervene arises. So therefore, all the strength that the US dollar index can gather is from the movement of oil and from the news coming out of the war zone, which is the war between United States of America and Iran, and the war about, or the fight for the opening of the Strait of Hormuz, and the second strait that has been controlled by the Houthis, which is between Yemen and Saudi Arabia. So these are the two straits that need to open to allow ships to transit and allow more supply of oil to be available to the global economy. The chart on our screen is that of NQ, the Nasdaq based ETF, and we're looking at the daily chart. NQ has managed to move down, and it's once again trying to take out the buy orders in the demand zone between 27995 and 28501, which is a nice strong demand area with a lot of buy orders, and one needs to see if the increased strength in the dollar, the increased strength of the US oil spot, and if the opinion of the global economy or the US economy is going to allow this particular index to print more of bearish candles and break below 27995 to establish a new downtrend. It needs to close below the 28,000 area in order for us to go back into the supply between 29173 and take a short with a stop loss above 29384. That's a nice area to short the index if at all it gets a chance to come back, or we can also try to look at lower time frames to go for a short, but no longs as we speak. There is also a nice area between 29235 and 29374, which could act as a nice seller's area, or we could take a chance at 29029 as well with a tight stop loss above 29132, so that if at all we get broken out, we do not lose too much of money. But this area is a better area, which is around 29250 as entry and 29358 or 360 as the area for a stop loss. The chart on our screen is that of ES, the S&P 500 based ETF, and we're looking at the daily chart. The ES is not as weak as the NQ because it's not loaded with IT stocks as much as the NQ, and also the bearish candles printed recently have not been as explosive or as strong as those printed on the NQ. In fact, the candles printed on Wednesday and Friday were just dojis, and they close above. The close on Friday was above the close on Thursday, and we still need for the downtrend to set, or the bearishness to set into this particular asset class before we can say that it has become bearish. There is still a lot of resilience and strength left, and as of now we can go for a sideways trend by going long at 7430 and a stop loss below 7377, or a short, which is a better trade, at 7632 and the stop loss going above 67688. So that's the trade we can enter into if we want to trade S&P, but the stop losses have to be very tight, as it could break down or it could break up in any direction once the news from the war zone changes. The chart on our screen is of Nifty, the National Stock Exchange Index from India, and we're looking at the daily chart. Why we're visiting this chart is because of the reason that it has broken a nice support area at 23800. It gapped down and then it managed to go up and close very near the support area at 23800. It needs to be seen if it goes back up again and tries to reverse from the sellers area between 24133 and 24335, or it goes further up and tries to come back from 24600, which has been a very important resistance area, and it used to be a support area once upon a time. So therefore there are two ways that this index could travel. The first one could be it's continue to drop towards the next support area at about 2300, or it could go back into the newly established supply at 24133 and could again reverse back with establishment of a lower high and the announcement of the newly formed downtrend, because as of now we can see that the index has been trading sideways and we still cannot say that there is a bearish trend in the market, because it needs to go down further and close with a nice bearish red candle to show that it has come out of its sideways trend and is now trending downwards. The chart on our screen is that of XAU/USD, the gold-based ETF, and we're looking at the daily chart. XAU/USD has shown some strength, and like silver, it had a bad day on Thursday, throwing a lot of its gained momentum, and then it printed a doji on Friday, and one has to wait and see if it manages to take out the sell orders or the supply area between 4160 and 4200. So that's the immediate supply zone that it's trying to get out of, but there is also a nice strong support on the lower side, which is between 3945 and 4010. So that's a support area that it needs to take out if it has to go down further and print lower highs, or it should take out the supply right on top between 4160 and 4200 and close above this area to try and break out of its downtrend and start trading either sideways or towards the upside. The chart on our screen is that of XAG/USD, and we're looking at the daily chart. XAG/USD has managed to recover some of the losses from last week, although it threw away quite a bit of its regained momentum on Thursday and then printed a doji on Friday. So we do not know if it can take out the supply around the 59.45 to 60.75 area anytime during this week or anytime in the near future, because it's still bearish and the best move is still towards the lower side, and the best zone as of now to trade is the supply zone at 61.7 and the stop loss going above 64. So the zone between 61.7 and 64 is a nice supply area with a lot of sell orders left behind, and one could still try to get short until the trend reverses and we see the establishment of higher lows after higher lows, and a close above 64 could show the beginning of an uptrend, or at least a sideways trend in this particular asset class. Coming back to the option strategies that we're going to use for trading breakout situations or for getting into breakout trades where the underlying has been trading in a range for a very long time and we expect some kind of information like earnings announcements or the Fed chair's announcements or some other information that could take the price of the underlying in any direction without us predicting the direction in which the gap up or the breakout is going to happen. But our trade shall be based upon the expectation of an explosion or inflation in the implied volatility conditions of the market from being neutral to low to an extreme high. The higher the volatility, the better are our chances to make a profit out of this trade. The first strategy that we're going to talk about is the reverse iron condor strategy, which is a combination of two different spreads. The first one being the bull call spread and the second one being the bear put spread. What we do is we buy two options, one call and one put on either side of the ATM, so slightly OTM. Depending upon the volatility condition, we would like the price of buying these options at the lowest possible price. So therefore, the lower the implied volatility at the time of entering, the better it is, and then we go up for a sale of an OTM option with the highest open interest on the call side, and then we go down to sell a put option OTM with the highest open interest. So these two sales are going to finance our trade or give us a credit to make the entry as cheap as possible, and we could be in a situation where we are at the minimum level or the trade could be as good as a free trade for us. But one has to realize that the closer that the spread between the two options, which are the long OTM and the short OTM, or the long put and the short put, the closer that the spread is, the lesser our profit is going to be. So in case we do not want to sacrifice a bigger part of our profit to make the trade cheaper, we should try to keep the OTM option that we're going to sell as far as practicable, but with a very high open interest, which could act as a resistance to the call option that we've gotten long into, and the other one could act as a support for the put option where we've gotten long. So both these sell trades or the strikes are going to be the target area for the long trades that we have gotten into. There is a chance that the long trades can go worthless if the price does not move at all, because what we are trying to do here is that we are trying to expect the price to break out of a range that has been into for a long or an extended period of time. So our timing has to be absolutely correct, and the options that we're going to buy should not be more than 7 to 21 days to expiry. The shorter the period, the better it is, because we do not want to stay or linger on in these trades, as time decay is against us in this trade, and the longer that we stay, the worse is going to be the premium of the longs that we have entered into. We would like to time our trade or time the entry into the trade with the release of the explosive information that we had preempted. Whether it goes in the upward direction, whether it goes in the downward direction, we still end up making money, but only when the trade makes a violent explosive move, printing a nice bullish or bearish candle that takes away the debit that we had paid at the time of entry, and then it also gives us a profit on top of the expenses that we incurred while getting into the trade. The other option strategies that we can follow while getting into a breakout trade are going to be the strangle and the straddle. When we use the strangle, we go in long on a call as well as a put option at ATM, where we invest the highest amount of price to get into the trade, as there is no credit being received like what we got in the reverse iron condor. And the other one is the straddle, where we buy a slightly OTM call option and a slightly OTM put option on either side of the ATM. But in both the strangle as well as the straddle, we once again expect the market volatility to explode infinitely. As much as the implied volatility rises, that much is the inflation in the premium of the option trades that we've gotten into, and that's how we make our money in one direction. It all depends upon which of the two trades has triggered, and then we expect the market to continue moving endlessly in that particular direction, because a reversal is going to cut short our profit, and a maximum movement in either of the two directions is going to give us the maximum profit from these trades. These trades do not expect the market to turn around after making a move in either of the two directions. That means if the market is going down, then the put trade is going to make us profitable, and we continue to expect the market to continue to be bearish. And if the market goes up, then we would expect the market to continue to be bullish, giving us a profit with the inflation of the value of the call option that we go into. The third trade that we're going to talk about is the front ratio spread, where we can try to keep the distance between the long ATM or the ITM strike and the short OTM strike as far as practicable, so that we can make the maximum amount of profit from the movement of the long call or the put option that we get into. Here, the trader first buys a long ATM or ITM, and then buys two or more OTM shorts, or there is a sell trade to finance the long debit trade. But the idea behind getting into this trade is to retain the credit that we've received from the two sell trades that we've got into, and we expect the underlying to stay as close to the ATM as possible or below the OTM strike in case of the longs, or above the OTM strike of the put option where we've got in short in case of a put front ratio spread. So therefore there is a short delta bias in case of the call option trade, and there is a long delta bias in case of the put front ratio spread. The idea is to retain the money from the two shorts that we have sold, and also to make money from the movement of the underlying towards the OTM strike but not crossing the OTM strike. Therefore, we do not expect the implied volatility in these conditions to be very high, and it's not a breakout trade. It's in fact a range bound trade where the long is at the entry or at the demand level and the short is at the supply area or the target level. Ladies and gents, traders and investors, we now come to the close of our presentation on breakout for free option trading strategies. We've touched upon various kinds of strategies, and we've also discussed the importance of various kinds of parameters that we need to keep in mind while getting into these trades. They are very sensitive trades, they're short-term trades, and there's very little time for us to have a successful trade or a failed trade, and it's one particular parameter that could turn a profitable trade into a loss-making trade. So therefore, please try and keep a very good eye on 4 different parameters. The first one being the selection of the resistance or support area for the OTM short that we enter into in case of the reverse iron condor. It has to be an area where the open interest volume is the maximum. Then we look at the time of entry. It has to be precise and it has to be aligned with the news or the information that we expect to give us the explosive move that we're looking at. The third one being the time decay or the expiry day. The expiry day shouldn't be too long because we're not looking at losing the premium through lingering into the trade. Then we must look at the implied volatility, which could be low to moderate while entering, so that we pay the lowest of the premiums to enter into the long. And then there has to be an explosion in the implied volatility, because without the explosion we cannot get the price swing that we're looking at, and we should try to get out of the trade at the soonest once it has hit our target or either of the two OTM prices, because we do not expect the price to reverse on us and limit or cut our profits. We therefore hope that you've found the information good and usable for your trades and very informative and exciting enough for you to come back and watch all our videos from time to time. If you've liked our videos, please hit the bell icon and subscribe to our channel Polo Vega. You may also visit us on our website www.polovega.com or get in touch with us for Twitter handle @Polo Vega. We wish you all the very best for the forthcoming week, and please trade safely until we meet next with a new option strategy with our commentary on the events that would occur during the forthcoming week. And until then, we thank you for watching all our videos. Please like, share and subscribe to our channel Polo Vega.